Well, it's been nearly a year since the collapse of three U.S. regional banking lenders left regulators scrambling to avoid a banking crisis. Interestingly, here we are a year later, and investors are once again worried about the regional sector. We've seen some of the headlines recently surrounding New York Community Bank and its exposure to commercial real estate and whether there's a worsening issue for some of the regional banking players. We wanted to bring back Sheila Bair. She is the former chair of the FDIC and a senior fellow with the Center for Financial Stability to get her sense on what's happening behind the scenes right now. Sheila, it's a pleasure to have you back with us here on BNN Bloomberg. First of all, I guess for this whole situation surrounding New York Community Bank, which is a bank that really got bigger with more exposure to commercial real estate through deal activity that it did, what's your assessment of what's going on right now?
Yeah, well, it seems to me there's some management issues there. They seem to be under reserve. They had a huge increase in their loan loss reserves in their last financials. So I think that's of concern. The regulators are on top of it now, but they were approved to acquire deposits in significant part of the assets of Signature Bank, which failed, which is getting some scrutiny now. And of course, regulators had approved their previous acquisition that had those combined has put them over $100 billion. So I think there's a lot of problems here. Weak management, apparently rapid growth, some of which the regulatory process seemed to facilitate. But the more fundamental problem, I think, is that does this suggest that there are other regional banks out there that are under-reserved for commercial real estate? We've known this has been a problem for a long, long time. And you know, it should have been dealt with. They shouldn't be playing catch up now.
Yeah. On the subject of contagion, I just want to be clear, you know, this is a bank that, at least as measured by market cap, which is only one measurement of a company, I think it was something like $8 billion before the issues at hand came to the forefront. I mean, I think JP Morgan's got a market valuation of like $500 billion. And certainly New York Community Bank, in terms of its size, arguably less significant, you know, if you could put it that way, than, say, Silicon Valley Bank. So this bank is getting a lot of headlines. Does it represent a systemic risk, do you think, to the banking sector?
Well, I think no, this size bank does not. I didn't think I had to agree to disagree with my colleagues last year. I didn't think those bank failures were systemic either. But it could create stress, especially in credit availability for small and medium-sized businesses where regional banks are very dominant. Again, I think the vast majority of regional banks are just fine. They're well managed, but there are some pockets. I'm sure, you know, we've got a lot of stress in commercial real estate. Part of that's due to interest rates. Part of that's due to just the transition to remote and hybrid work, which is creating high vacancy rates. So no, I don't think this is going to be systemic, but I do think it could cause more instability with uninsured deposits for regional banks, which could, even the healthier ones, which could distress them further. And it's frustrating to me that the Biden administration still has not gone to Congress to ask for the FDIC to reinstate their emergency authority to do temporary transaction account guarantees, expanded deposit insurance for uninsured depositors during this time of turmoil. The Trump administration did it during the pandemic. It was not controversial. They actually didn't even have to use it. But now we still have a problem with uninsured deposits. And if one or more of these regional banks go down and there have to be losses on the uninsured depositors, I think you could see broader problems with instability and uninsured deposits, at least in banks that are not too big to fail. And of course, that helps them competitively because those deposits go there. They go to JP Morgan Chase and B of A.
Yeah, and the fact that this is a presidential election year, do you think, just depending on how things play out from here, some of the stuff you're talking about gets more nationwide attention?
Well, I think that's a good question. I'm not sure how the presidential politics play into this. I think they definitely have an impact on this ongoing debate over the Basel III endgame proposed capital rules. A lot of controversy and industry opposition to that. Some speculate, I think, with justification that the industry's long game is to stall these rules until potentially a Republican administration comes in and a Republican Senate as well to try to roll them back. And so I do think in terms of strengthening the capital rules through that package, very massive package of enhancements, presidential politics definitely play a role. But what's going on now? No, I don't. I think we have a real-time problem with commercial real estate. and some banks being exposed. And I know the supervisors, the FDIC put out some excellent guidance on this late last year. The supervisors are looking at the level of those reserves. And we changed the rules around reserving several years ago so that they're supposed to take a forward-looking view through this cycle, all market conditions, not just historical loss rates. And again, we've known commercial real estate's been a problem for a long time, especially in New York, where they have an additional problem of rent control for multifamily housing, which has made a lot of multifamily housing unprofitable and really, compounded the problems by hitting the valuations there as well. So, no, I think longer term for the regulations, presidential politics make a difference now. I think this is just purely banking 101, get your reserves up. You got a problem with commercial real estate. If they do that, hopefully they have enough capital to be resilient and absorb the losses. And I think, again, the vast majority are just going to be fine. But you could have some knock-on impact for uninsured deposits if a couple of these regionals, a few more go down. And this time the FDIC has to impose losses on uninsured because they don't have the authority to cover. And Congress sets the insured deposit limits, which is $250,000. And they made a systemic risk determination last time. I don't think that's going to happen again. So this is an issue. The Biden administration needs to go to Congress and get the FDIC's authority to reinstate what we call the transaction account guarantee. We used it during the great financial crisis. It worked beautifully. They need to do that again.
All right. You said Money 101. I was working with my 11-year-old on a financial literacy test she has this week over the weekend. We need to remind our audience, and there's a little bit in your backdrop there, that you've been the author of a series of books for children on money basics. Remind us how this all came together, Sheila, because it's definitely catching on.
Well, thank you. I appreciate the plug. Yeah, so I've had this side hustle, if you will, writing kids' books since 2002. My first one came out, Rock or the Savings Shock. Yeah, they're called Money Tales. There are 8 now. The 2 most recent ones I've got behind me deal with inflation and speculative bubbles, 2 side effects of easy monetary policy, which I think is important for people to understand, particularly in this day and age and what's been going on. So, yeah, I think kids need to understand this. They get it. The concepts are basic. The books are designed for parents to read with their children. So the parents tell me they learn a bit too, which is great. And so, yes, I've enjoyed it a lot. I think, regulation's important, consumer protection's important, but regulators can't do everything. People need to be armed with the knowledge to protect themselves as well.
It's